Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is April 4th, 2023. We got a big show coming up. We're going to talk about the kind of surprise that we had out of OPEC Plus this weekend. What that means basically is they're cutting the amount of oil they're outputting every day. What that means for you, what that means for inflation, and what that means for the market. Well, right now we have markets sitting at multi-week highs. Can it sustain this? We'll find out soon. All this and more coming up right now on Making Money. It's official. Mark Chaikin just went live with the biggest prediction of his career. A new wave of volatility is coming for the stock market, and investors need to act immediately. Mark's prediction is based on an indicator that has only triggered a handful of times in the last 72 years, and with a 100% success rate for predicting where stocks will go next. During Mark's 50-year career, he's worked alongside some of the biggest investors in history, including Paul Tudor Jones and Michael Steinhardt. In fact, Mark invented one of Wall Street's most popular indicators for picking stocks, still used by hedge funds, banks, and brokerage sites, and today found in every Bloomberg terminal on the planet. Now, Mark's inviting you to watch his brand new event as he explains exactly what the next wave of volatility will look like and where it will send stocks in the coming weeks. He's even sharing one of his favorite ideas free for those who tune in. He says this idea could create bigger gains than anything he's used his power gauge system for until now, by turning the coming market volatility to your advantage. But Mark says you must act today before more volatility hits the market. To watch his newest prediction in full, go to ChaikinEvent2023.com. That's ChaikinEvent2023.com. Hello again, this is Matt McCall. Thanks for joining me. It is April 4th, 2023. I want to take a look at the markets here before we talk about OPEC and we talk about the price of oil and how it surged on Monday and really what that means for your portfolio, for your wallet, and what it means for the Fed and inflation and potentially the whole U.S. and global economy going forward. So let's take a look here first at the S&P 500. Here's a chart of the SPYs, the S&P 500 ETF. As you can see here, early morning here Tuesday, we're up slightly, 0.1%. However, that's enough to put the S&P 500 here at a 6-week high, closing in on a multi-month high that we hit in early February, around the 418, 419 level, around 411.5 right now on the SPYs. I like the action as of late because you can see a little bit to the left of where we are now. In early March, we rallied up to a March high and closed around 105 that day. We blew through that last week. We're holding above it now. That's really a good sign, in my opinion. If we take a look at the QQQs, which tracks the NASDAQ 100 index, what we'll see here is an even more impressive chart. We're now trading at the best level that we've seen since August of 2022. And we're closing in on that August high. That's around 335 or so. We're at 321 and change, up about 0.4% today as the tech stocks are outperforming the overall market a little bit after lagging yesterday. So, it's a little bit of a back and forth. But as you can see, very nice looking chart trading at a multi-month high. It's really tough to really argue what's going on there. Now we'll take a look at the Dow Jones Industrial Average, the Dow 30. You see quoted everywhere. A bit of a different chart. You can see here it's trading at the best level. If we closed here yesterday, the best level in about 6 weeks as well, like the S&P 500, still off the really important kind of high around 34,500. We're around 35,600, give or take, right now, down slightly here on Tuesday morning. 34,500 is a level. You break above that, I think it could really move, but that is a level you want to keep an eye on. And then I want to take a look at two other kind of areas we don't talk about as much. This chart is the iShares Russell 2000, symbol IWM. This is going to be index of 2,000 stocks, small mid-cap stocks, down about 0.75%. And you can see in the chart, much different than what we saw on the S&P 500, on the Dow, and the NASDAQ 100. So what this is really showing us is that the smaller and mid-cap stocks continue to lag the big names. More specifically, the mega caps, which have held up really well. So as you can see here in IWM, we're holding above 165, which is a multi-year low that we hit in June, we hit in September, October. Came close in March, as a matter of fact. We're in the high 160s. We're at 177 now. A break below 165 is very concerning to me for small mid cap, and that probably means there's other stuff going on with the entire stock market. But we're holding above that now, and I do believe that we do have an opportunity this year to see the small mid caps turn around a little bit. Next, I want to take a look at IWC. This is the iShares Russell micro cap index. So these are the really small stocks, typically below $1 billion, majority of ones that make up this index. You can see, again, it has a support similar to IWM, where back in July, around 104, 103, down about 101 in October, down to 100 in March. We're at 104 now. The chart right now does not look good on this. And I got to be honest with you, the small mid caps don't look good right here. All that being said, I do think that they're setting up because of valuation metrics for small mid caps. I believe we will be setting up for a time where they're going to turn around. A couple of things. One, the small mid caps, a lot of times there's a lot of financials in there, a lot of regional banks. We know what happened to the regional banks as of late. So that's why we're seeing the small mid caps get hit quite a bit. Also, the last 18 plus months or so, there's been an no profit companies. That sounds weird. No profit. There's been basically a boycott on companies that aren't making a profit. Again, a lot of small mid cap companies are not yet profitable. It doesn't mean they don't have great growth on the top line revenue. Doesn't mean they don't have prospect to be cash flow positive at some point. It doesn't mean that there's not a great growth story and the underlying trend that I like. It doesn't mean any of that stuff. It just means right now in this market environment, it's very difficult for investors to get excited about companies that are not yet profitable. And that happens from time to time. That will turn around. All that being said, folks, that doesn't mean you just jump in and be superly aggressive right now with small mid caps that aren't profitable. I think you kind of hold off. If you have some in your portfolio and you like them, you're not saying get rid of them. But until we really see that part of the market turn around, I want to wait because I don't want to try and pick that bottom in case that support level in IWM or IWC does break. I want to hold off on that. So I said that was kind of just our quick update here of where the market stands. The other bit of big news that already will have come out by the time this airs, because we're taping obviously Tuesday morning, but at 2:15 Eastern time, ex-President Donald Trump is supposed to be turning himself in. We'll see what happens there. Will it be a circus? Will it be a non-event? I have no clue. I don't know if anybody really knows what's going to happen with that, but I don't think it's going to have much effect on the markets itself, to be honest with you. But you never know. You never know what can happen with this circus of political world we live in right now. And when I say circus, folks, I mean left, right, and center. I mean everybody involved in politics is an absolute circus. So we'll see what happens. But I wanted to put out there, obviously, that we're keeping an eye on it. I don't think it's going to have too much effect on the overall stock market. Now getting into the main topic here, and that is what happened on Sunday. That's when OPEC Plus came out. They announced voluntary cuts to how much oil is production per day. They came out with a combined cut. These are 8 countries that did this. Again, voluntarily, cut of 1.16 million barrels per day of production. And keep in mind, these, again, as I mentioned, it's important. These were voluntary cuts, not part of the OPEC Plus policy. So involved in here is going to be Saudi Arabia, some countries around here, Kuwait, etc. Russia's part of this. So this is something, again, that was not part of the overall OPEC Plus policy. As you can imagine, this sent oil prices high on Sunday into Monday. Oil trades not the same hours as the stock market, but trading on Sunday, and then we saw it here Monday in the U.S. markets. It was up about 8% at one point, surging, as you can imagine, because at the end of the day, price is based off supply and demand in anything in life, really, supply and demand. So if supply is dwindling, we assume demand stays stagnant for right now, prices will go up. It makes perfect sense. We have to ask ourselves, why did OPEC do this? And of course, there's many, many conspiracy theories behind it already, even though it's only been about 48 hours old. I'm going to give you my view of a couple of potential reasons why this happened. One could be, do the oil-producing countries see something that some others may see, in the fact that Maybe the global economy is on the cusp of a slowdown, bigger than we expected. Is the global economy about to go into a recession, which would lead to less demand for fossil fuels, less demand for oil? Because obviously, if economic production slows, it's less need for energy that goes into that. So that would mean less demand for oil, which means that they're cutting it right now so prices can remain high if, in fact, this happens. That's feasible, I think. I think there's definitely a good argument behind that. Could it be that OPEC plus, big part of that's Russia, is setting up for a situation where they're using oil as a weapon? And by that I mean, if they cut oil production, prices move higher, as we saw yesterday. And maybe it's only a short-term move, maybe it's longer term. And if the economy does not slow down, most likely prices will remain as high, if not go higher. That means the cost of creating goods and even produce services that take place in the United States and around the world, the cost of that will go up. Then we start looking at the inflation numbers here in the United States. Energy is obviously a significant part of that. And if oil prices go up, that means inflation will go up, which puts some pressure on the Federal Reserve to be hawkish, meaning aggressive, to raise rates more. And if that's the situation, then does it push, by that I mean higher interest rates, push the U.S. economy into a recession, a bigger recession than people think, maybe a recession that nobody was expecting? I don't know about that, but the point is it could result in an economic slowdown in the United States and some developing countries, which maybe Russia wants to see that. So I think there's a lot of different potential reasons for why OPEC Plus did this. And I think we'll probably see as it plays out over time what really led to this. I think that the Fed and how they deal with this is going to be pretty interesting to see that here. I want to see the comments that the Fed has to say about the oil prices if they remain high. But is there some type of collusion going on here? I'd have to think so. Both situations I lined out aren't very positive. It's either the economy is slowing down and OPEC Plus knows something, or they're attempting to slow down the economy. And either way, by cutting, again, production will help put basically a base underlying oil prices, even if demand falls due to them creating this, or not creating it, propelling it, or the OPEC Plus knowing it's coming. Either way, I believe you can see kind of that floor that they're trying to put in. And here's a chart of oil I'll show you here right now. It's around 81 and change right now. This is West Texas Intermediate, WTI, crude here in the States. As you can see in the chart, we actually hit about a 15-month low, lowest level since December 2021, in mid-March when we started to have the banking issues. We've now obviously rallied well above that. That was in about the high 60s at the time. Now, as I mentioned, we're at 81 and change. And we're up against a really important level because, as you can see, early December, late December, early January, mid-January, mid-February, early March, we were up to this level around 80 to 82 several times. And that was our resistance. If we break above that, just pure technicals, folks, it looks like we run to about 91, 92, which is over 10% from here. And I think that's possible. I think it's probably a 60, 40% that happens. Again, that's just based on technicals. A lot of other things could happen outside of, the pure technicals that can drive this. One thing that I think is important we need to keep an eye on is the reopening in China. And we had Brendan Ahern on last week. If you haven't seen that episode, please watch it if you're interested in China, emerging markets, or anything outside the U.S. One of the smartest minds when it comes to that type of investing. We talked about the reopening in China and really how it's kind of in early stages, and this reopening is going to continue. And you have to remember that China is the second largest economy in the world. If that reopening continues like it is and people start traveling, demand for goods and services continues to increase. we're going to see the demand for fossil fuels, oil increase, which again will push prices higher, supply and demand, folks. Especially if supply is coming down to the OPEC plus, demand remains high. That could be a concern. So there's always a way to kind of combat that, if from an investment standpoint, and that to me would be to look to have exposure to stocks that will benefit from higher oil prices. And over the last couple of months, in both my newsletters, we have been writing about what we call the barbell approach to the future of energy. And as high as I am on clean energy, because I believe the amount of money is being spent by private companies, the amount of money being spent by governments and agencies around the world will propel prices of well-positioned clean energy stocks higher. Just because when there's that much money sloshing around, the companies will get it. I don't think the adoption of clean energy is going to be nearly as fast as we thought, even myself, as I thought several years ago. But we can't argue the fact that there will be more solar, there will be more wind, there will be more hydro. I think there's going to be more nuclear energy as well around the world in the next 10 years. Battery technology is going to be better. It's more EVs on the road, more charging stations out there. But again, as I've talked about in the past, when it comes to the barbell strategy, you need dirty energy to create everything I just talked about. You can't create silicon wafer solar panels, wind turbines, offshore and onshore, that are enormous. You can't create this without dirty energy. It just doesn't happen. So when we see this shift to clean energy, it's sometimes viewed in a really singular way. We don't realize it takes a lot of dirty energy to get there, which again tells me demand for fossil fuels will remain high for the next decade plus. So I think having some exposure to dirty energy, if you will, and that could be through a lot of different ways. And I'll just show you a chart right now of the kind of the bellwether of the energy sector as far as ETFs are concerned. And this is XLE. This is the Spiders Select Energy ETF. Again, symbols XLE. We're down this morning about 1.4%, but you can see the huge gap up on Monday based again on that decision by OPEC plus. And it's really been holding up pretty well. We did break down in mid-March, and that a lot of that had to do with the banking issues, thinking, wow, where's this leading? And they kind of sold off everything. But it bounced back really fast, even before the OPEC plus decision. So it's really gone sideways a lot in the last 7-8 months or so, basically almost a year, going all the way back to April of last year. And but I will tell you, if I look at a long-term chart here, you can see that why I'm kind of bullish, because we broke above a high of $80 that we hit back in 2016, 2017, 2018, and we're kind of holding above that. So that is a good long-term view of the markets, in my opinion. So again, that's just one way to look at how the big basket has done. And those are going to be the big names. When you take a look at the holdings of XLE, it's really going to be kind of exactly what you would predict. ExxonMobil, Chevron, Marathon Petroleum, EOG, ConocoPhillips, SLB, Valero, Occidental, which is a big favorite of Warren Buffett, is in there, Halliburton, Baker Hughes. So really, it's going to be a lot of the big name energy companies that you know and I say love. You may not love them, but you know them. And then there's the oil and gas exploration and production. So a little bit different makeup here. And the symbol of that is XOP. This one has not performed as well. But again, down today even more, 1.9%. Did gap up yesterday, as you can see. Good support around 110 to 115. But it's kind of in no man's land right now. And when I look at XOP, you look at the top holdings, Marathon Petroleum, Occidental, Valero, EQT, CNX, Hess, Pioneer Natural. And then we have ExxonMobil, Chevron, EOG are in there as well, near the top 10, but not nearly as big of a portion of it. But there's a lot of different oil and gas and energy ETFs. The same can be said for clean energy ETFs at the same time. So I'm not recommending you run out and buy an ETF. I still believe that you create your barbell with individual stocks, and that includes some dirty energy stocks over here. And you don't want to be all mega cap, ExxonMobil, Chevron. You want to have some mid caps in there as well. You want to maybe look for some exploration, maybe some LNG related, maybe some infrastructure related. stocks in there. You don't want to go all eggs in one basket. Then on the other side, let's think of clean energy. You don't just do solar. You don't just do wind. Maybe look at some battery technologies. You look at some material technologies that are used for solar, used for next generation batteries. And you really want to kind of create your own ETF with these two sides of the barbell. And again, we've started creating this already in both our newsletters, the McCall report and MMI, which is looking at megatrend investors. So we've created that, and we'll continue to add to that, because I believe both of these sectors can be very big winners, and they have to be married together. Because the news that came out this weekend, the uncertain world that we live in right now, you want to have some exposure to the dirty energy, because it could be used as a weapon. If it does, we're going to see very high prices. That being said, I still believe that we have a global economy that's going to continue to move higher, continue to grow, and you're going to need dirty energy for that. So you don't want to ignore that side of the barbell, folks, at all. Please keep that in mind. Do not ignore that. And again, people often pigeonhole me as a tech innovation guy. Get tech out of there. I'm definitely innovation. That being said, I'm an opportunist, and I believe right now there's an opportunity for some dirty energy in a well-balanced portfolio for the next several years. So I hope you enjoyed the show. Let's hope OPEC is wrong. I hope my two thought processes behind why OPEC Plus did this are wrong as well. And it's a one-off. And hey, but we have to be realists, and we have to look at it in light of why that may have happened. But again, right now we have the stock market, taking a look at it here Tuesday, pretty much flat, kind of right where we were when we started the show. We'll see how we close. But as I mentioned, S&P's at a 6-week high, Dow similar, NASDAQ multi-month high with the small caps lagging. And of course, oil and gas energy stocks up this week so far on the OPEC Plus news. Again, thank you so much for watching. Remember to like, share the video, tell your friends, your family. I hope you have a great rest of Tuesday, Wednesday, back Thursday. We're having on my doctor. My personal doctor will be joining us, talking about longevity and what I do to help longevity in my own life, what you can do, and of course, different ways to invest in the longevity boom that is coming right now to the entire world. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.